everyone. I hope you're doing great. In today's video, we are gonna learn about SA 240, Auditor's Responsibilities Relating to Fraud. And this covers CA Intermediate Paper 5, Auditing and Ethics. So what we will cover today, we will cover fraud versus error. There's one story. Second one, two types of fraud. Third one is the fraud triangle. Fourth one, who is responsible? Fifth one, professional skepticism. Sixth is auditor's procedures. And seventh is most asked exam questions. This is very, very important. Let's get started. Okay, before we start to essay 240, I want you to think about this. You are at a wedding, your cousin, let's call him Rohan, comes to you and says, I need 2 lakh. I'll return it next week. It's kind of urgent for my business. I promise. What you do is you give it. 3 months later, nothing. He doesn't pay you back. When he takes the money, he says, I'll pay you within 3 months. But after 3 months, also, he's not responding, nothing. His phone is switched off. Now, tell me, was that fraud or were you just unlucky? The answer is it depends on the intent. What was his intent? If Rowan always planned to run, that's fraud. But if he genuinely lost money and couldn't repay, that's an error in judgment but not fraud. This one word, what is that intention behind Rohan's mind, is the entire soul of SA 240. SA 240 deals with the auditor's responsibility when it comes to a fraud in an audit of the financial statements. And it boils down to one question: did he do it deliberately? And that intention, he called it as fraud. Let's move on to this segment 2, that is fraud versus error. Let's make this super clear first. Imagine a small kirana store owner. Very easy for all of us to understand this, right? Ramesh bhaiya, the kirana owner, his name is. He has one assistant named Suresh who handles the cash counter every day. One evening, what happens is Ramesh bhaiya is tallying the daily's cash and notices 200 is missing from the register. So now there are two possibilities for this, for the missing in cash. Possibly this assistant Suresh was busy during the evening rush because people come to the store in the evening to buy stuff, right? And gave a customer 200 extra change by mistake. This is what his assistant must have done while juggling multiple bills at once. He didn't even realize it. That's an error, right? He paid someone extra by mistake, gave change. That's an error. There is no intention, just a genuine mistake under pressure because there was a lot of work. He committed a mistake, and that is genuinely fine because it is a mistake and there was no intention of fraud, right? Yeah. And possibility two. Possibility one was he was busy with work, was juggling and a lot of work, and he gave by mistake 200 extra to some customer. Possibility two. Suresh has been quietly slipping 200 into his pocket at the end of every shift for the past 8 months. He even adjusts the daily sales entries slightly so the numbers don't look off. That's fraud. He knew exactly what he was doing. He planned it and he actively hid it. This is fraud, the intention behind Suresh and possibility too. So SA 240 says misstatements in financial statement can come from error or fraud. The distinguishing factor is what? Intention. What is the intention behind it? Now, here's the scary part for the auditors. Fraud is harder to detect than errors. You know why? Because Suresh makes a genuine mistake. That's messy, that's traceable, that's obvious. Mistakes are traceable, right? But Suresh, when he is stealing, he has been quietly adjusting the entries for 8 months. He carefully covers his track. The fraudster is always one step ahead, right? Because he knows he's committing something. So he's trying to clean off the books. That's what the person is doing in the second scenario. Going back to Rohan's case, your cousin's case, if he genuinely forgot to repay, he would pick up your calls, right? Apologize, try to work something out. But if it was planned from day one, his phone is off, he's blocked you on Instagram, WhatsApp, and his mother says he is out of station. Same logic, the deliberate concealment is what makes it fraud. Got my point? Now let's move on to the types of fraud. There are type 1 and type 2. First one is type 1, fraudulent financial reporting. This is when management cooks the books to make the company look better than it is. For example, think of a startup trying to raise funds from the investors. Revenue is actually, 50 lakhs, but they show it 1.5 crores on paper. Inflated sales, right? Fake invoices, backdated entries, investors pour in money based on this false statement. This is fraudulent financial reporting. You are making some adjustments in the financial statements. Now, connect it to Rohan. Imagine Rohan doesn't just borrow from you. He shows your entire family a fake bank statement saying he has 10 lakh in savings, borrows from every uncle and aunt at the wedding, and disappears. He manipulated the reporting of his financial position to deceive multiple parties, saying that is rich and he just needs some money to, for my business. And everyone lends the money thinking that he has the capability to return the money in future. But at the end, what happens? He runs off, right? Same concept, bigger scale, that is fraudulent financial reporting. Famous real world cases, Satyam computer scam, if you know, Chairman Ramalinga Raju admitted to inflating cash balances by over 500 crores. Classic fraudulent financial reporting. Got my point? The type 2 one is misappropriation of assets. What does it mean? This is when employees steal from the company. Remember Suresh from our kirana store, 200 a day, 8 months, that's 48,000 gone. Now scale that up. A purchase officer in a company creates fake vendor invoices, gets the company to pay and pockets the money. That's misappropriation of assets. There is a fake vendor. They're showing that we are taking some services that also is fake and they're making payment for that. And that payment is ultimately going to that manager, right? This is what it is. There are key differences between type 1 and type 2 fraud. Type 1 fraud, fraudulent financial reporting, management or senior level. Purpose is to, it is done by management or senior level. What is the purpose? Purpose is to mislead the investors and lenders, scale up. Usually the fraud amounts are large. Misappropriation of assets, employees or this is done by employees or lower level. Purpose is personal financial gain, like that manager was getting the money from the company via sales, fake invoices, right? Scale can be small or large, you never know how the intent, the power he has. Yes, his authority and everything. Let's move on to the segment 4, that is the fraud triangle. So, what is fraud triangle? Now, why does fraud happen? SA 240 gives us the fraud triangle. Three conditions, that is that when they come together make fraud likely. Think of it like a gas leak, a spark, and a closed room. Any one alone isn't dangerous. All three together, explosion, right? And let's understand all three through Rohan. Corner one, that is incentive or pressure. Rohan needed money urgently. Maybe he had debts or wanted to fund a business or living beyond his means. There was a reason he wanted the money. In a company, the CEO is under pressure to show profits to the board. The sales manager won't get his bonus unless the targets are met, right? There's an incentive or the pressure. I have to show good profitability. Salesperson, I have to show great numbers. The sales are done. Targets has to be met. That's why there is one pressure or incentive. If sales targets are met, you'll get money. If I show higher profitability, I'll get investors. Second one is opportunity. Why did Rohan come to you specifically at the wedding? Because he knew you are generous, you trust family, and you probably wouldn't ask for a written agreement or a collateral. There are weak controls, right? In Ramesh, bhaiya's kirana store as well, Suresh handled the cash alone. No daily cross check, no CCTV on the counter. Opportunity existed because the controls were weak. The owner was not checking once in a week or on daily basis. There was no reconciliation made. And even in your case, you didn't want to create a contract or ask for collateral with Rohan, right? So there's an opportunity. Corner number three is rationalization. What is the rationalization? Rohan probably told himself, it's family, they won't mind. I'll return it soon. Anyway, Suresh probably thought Ramesh Bhaiya makes good money. He won't even notice 200 rupees. I'll stop next month. In a company, I have given 15 years to him, to this firm, and they underpaid me. I deserve this. Everyone does it. This is the kind of mindset they have, right? They tend to kind of, normalize it. It's okay. Company is doing well. I can do it. That's a small amount and everything. This is the most dangerous corner because why? Because it lets the fraud continue the guilt, right? For your exam, if a question gives you a scenario and asks, identify fraud risk factors, look at these three. Is there pressure? Is there opportunity due to weak controls? And third one, is there any sign of rationalization? Are is that person very normalizing it? Second one is there opportunity due to weak controls? There are no controls in place, no maker checker. There is one person handling the cash. No controls, right? There is no segregation of duty. All three should exist, right? This is an important question. Segment 5, let's move on to who is responsible for fraud? Here's a question that confuses a lot of students. Give me 1 second. In the exam, so is the auditor responsible for preventing fraud? Absolutely not. SA 240 is very clear. What does it say? Let me move my screen up. SA 240 says the primary responsibility for prevention and detection of fraud lies with the company, that is management, and those charged with governance, meaning the board of directors and audit committee. Auditor's job is just to obtain reasonable assurance that financial statements are free from material misstatements, that's all, due to fraud or error. That's all. Back to Rohan, whose responsibility was it to ensure Rohan doesn't borrow and run. Your families, they should have done background checks, asked for collateral, had proper agreements in place. You, the auditor in this analogy, were simply asked to verify whether The family's financial records are accurate. You weren't hired to be a private investigator tracking Rohan down, right? That's all. And for Ramesh Bhaiya's store, it's Ramesh Bhaiya's job to install proper controls, daily cash reconciliation, CCTV cameras, surprise checks. The auditor who comes to audit his books wasn't hired to act as a security guard at the cash counter. You can't expect that from the auditor, right? To be an investigator. Important exam trap here. Auditor cannot give absolute assurance, but he only can give reasonable assurance. Why? Because fraud involves concealment, forgery, collusion. The risk of not detecting fraud is always higher than not detecting an error, right? Just like how Suresh carefully adjustments made him harder to catch a simple arithmetic mistake. This is the entire thing about the responsibilities of fraud. Next, we will move on to professional skepticism. Essay 240 has one golden rule that runs through the entire standard. Maintain professional skepticism throughout the audit. In plain language, don't be naive. Don't assume everyone is, honest. Question things like why is this happening? Who is the maker? Who is the checker? Why the process is like this? Why it is designed like this? You need to question things. If your family had been professionally skeptical about Rohan, they would have said, we, you're my family, but you can show us what the 2 lakh is for. Can we transfer it directly to the person you owe? That's skepticism, not rudeness. And why it is required. I know you're a family member, right? Why it is required, what was the business for, and etc. The more you dig in, the more you understand why it is required, right? And you can easily catch if people are lying or not. It's just a professional caution, is what I can say. If Ramesh Paya had been more skeptical, he would have said, Suresh, let's tally the cash together at the closing every day. One simple control, and Suresh never gets the opportunity, right? Essay 200 also says, do not override skepticism even if you have the past experience with a client who has always been honest when you're auditing, when you're going for auditing. It's always honest, but still, you need to have professional skepticism. You can't say, oh, he's my friend. Nothing. Oh, I've been talking to him. I've been dealing with him for 5, 10 years now. I know him. No. Your family trusted Rohan because he would never done this before. Past honesty doesn't guarantee present honesty. This is crucial. Two risks that are always presumed, no exception. Risk of management, override of controls. Management set up controls and can also bypass them, right? They themselves can set up the controls and they can also bypass the controls, right? So you always need to test the controls. And the second one is risk of revenue recognition fraud. SA 240 presumes that this always, not only when red flag appears. This is how the revenue is recognized. Everything needs to be evaluated, checked. Segment 7 is audit procedures under SA 240. Okay, so now the auditor suspects fraud. What does he actually do? SA 240 tells us. Step 1 is discussion amongst the engagement team. Engagement team is nothing but the team members. Basically, audit team. Audit before the audit begins, the audit team sits together and brainstorms whether where could fraud happen in this company? What are the red flags? This is a mandatory discussion under SA 240 before the start of the audit. Example, team auditing a real estate company discusses revenue recognition on long-term projects is risky. Let's pay extra attention here. They might pre-recognize the revenue, right? Step two is identify and assess fraud risk. Gather information from management, internal audit, analytical procedure. Ask management directly, do you know of any actual or suspected fraud? Just like someone should have asked Rohan, is everything okay? Why do you need so much money? Step three is respond to assess risk. Design audit procedures specifically to address the fraud risk areas. If there's a risk of fictitious sales, external communication from debtors needs to be obtained, right? Check dispatch records if you have sent the goods. Verify subsequent collection, not just ticking the invoices. You can't just sit and tick invoices. I have made the sales. Okay, the sales has been recorded, but have corresponding cash come into the bank statements, how the collections have been made, are they given huge discounts? All these things you need to consider. Then you move to step four, that is if fraud is discovered or suspect. Now, what you in step three, what you do is you were vouching, auditing, you found the sale is made of 10 lakhs, collection is of 1 lakh and 90% discount is given later on, you identify this risk, right? If fraud is discovered or suspected, this is suspected, report it to the appropriate level of management immediately. If management itself is suspected, go to those charged with governance, that is board or audit committee. Consider whether to continue the audit, possible reporting to regulatory authorities if required by law, right? And next we'll move on to segment 8, that is revenue recognition and management override. What is this? Exactly. So SA 240 presumes revenue fraud risk always exists. So auditor must test cut of are sales booked in the right period? Are they pre-booking the sales? Check journal entries around the year end. Are they booking provisions? Any unusual adjustments? Are they charging excess depreciation or lowering the depreciation? Confirm large debtors directly. If there are any large debtors, money receivable. For example, there is money receivable of 5 CR. They have made sale and you want to cross verify. Just check. Take confirmation. Also, extra checks, what you can do is public domain search. If that business actually, public domain search is nothing but Google search, checking if the business actually exists or not, or is it a fictitious business, cross verifying it, right? Do some extra searches. That's what it is. Example, companies booked 2 crores of sales in March, auditor checks, goods were dispatched in April, sales artificially inflated to meet the year-end targets because year-end may they show a lot of sales, right? To show profitability, classic revenue fraud. So you also need to see in April or May, if the cash is received for that sale or not when you are auditing, testing it, obviously. Think of it like also Rohan telling everyone at the wedding, he's already has a job lined up paying 1.5 lakh a month, but the offer letter is dated 3 months later. The numbers are real, but the timing is manipulated to create a false impression right now, right? That's exactly what revenue cutoff fraud is. And then management override of controls. Even if controls are strong, controls are placed, maker checker is in place, CCTV cameras in place, whatever it is, like in kirana store as we discussed, management can bypass them, right? SC 240 says auditor must always test for this. I know there are controls in place, but you still need to check, right? Always test for this, take samples, and you need to do an end-to-end, start-to-end testing, end-to-end testing, regardless of the assessed risk. How? Examine the journal entries, especially non-standard, unusual entries near the period end, lot of provisions booked, and etc. Review accounting estimates for bias, like depreciation. How have they charged? Have they changed the method of depreciation for their profitability and everything? Review accounting estimates for biasness. Evaluate business rationale for significant unusual transactions. Related party transactions you can check. And also how to check if the vendor is fictitious. Check if that vendor, check for the larger sales made, then also check in public domain if that vendor actually exists, check for the relationship with the employee, what you can check a lot of things, right? Segment 9 is quick exam recap. Let's do this. Fraud is intentional, error is unintentional, right? The difference is the intent. Suresh who planned it versus Suresh who gave wrong change by mistake. These are two examples. Two types, that is fraudulent financial reporting, that is management cooks books, and MOA is employee steals assets, like misappropriation of assets, like Suresh at the kirana store did it. Fraud triangle, what is fraud triangle? It should be incentive, opportunity, rationalization, IOR. Rohan had all three at the wedding, right? Responsibility, management prevents, auditor detects material misstatement, not the same thing, right? Management's responsibility. It is auditor just detects by testing the samples and everything. Professional skepticism, always question, never assume, oh, they are sweet. I know him from 5, 6 years. No. Always you have to test the samples end to end, even if the controls are in place, right? Even if the client has been clean for 10 years, nothing you have to test. Two, presumed risk. What is that? Revenue recognition, fraud, and management override of controls. Revenue recognition is there is a risk that management might inflate the revenue so that they get good investors. And then management override of controls. Even if the controls are in place, you have to check, test it if management has bypassed the controls or not for your safety. If fraud found, what you have to do, you have to report to the management. If the management is involved, go to the board or the audit committee, consider reporting it to the, and if the board does it, what to do, consider reporting it to the regulators, right? Auditor is a watchdog and not a bloodhound. He is expected to be alert, not to investigate every possible crime. But if there is a bone buried in the yard and the dog just sits there without sniffing, that's negligence, right? SA 240 makes sure the watchdog is always on duty. And there are questions ICI has been repeatedly asking across RTPs, MTPs, and past question papers. For each question, there's exactly how to structure your answers, right? 5 markers are what are the auditor's responsibilities relating to fraud under SA 240? How does it differ from management's responsibility? Next type is during the audit of the ABC Limited, the auditor discovers that certain sale invoices appear to be fictitious. What would the auditor do? Follow this. So, for this to answer, you can say that follow this flow, maintain professional skepticism, do not ignore, discuss with the engagement team, perform additional audit procedures, external confirmation, what we discussed, report to appropriate level of management, all this, right? So, that part you have to write. And then explain fraud triangle. We just discuss incentive, pressure, that is opportunity and rationalization, and explain the pointers. First one we didn't discuss, right? What are the auditor's responsibility into fraud under SA 210, 240? How does it differ from management responsibility? That was first one. That is open by stating that the primary responsibility is of management and TCWG. TCWG is nothing but those charged with governance. They must design and implement controls. Auditor is just testing it. Auditor's responsibility is to obtain reasonable assurance and that the financial statements are free from material misstatement due to fraud or error, right? And the auditor must maintain professional skepticism. All this you have to mention. Then most confusing, this is this part. Can an auditor be held responsible if fraud goes undetected during a properly conducted audit? What to say? So start like this. Auditor provides reasonable assurance and not absolute assurance. This we discussed. Fraud involves deliberate concealment, forged document. I told fraud, detecting fraud is very difficult because the fraudster plans it ahead, right? Which makes detection harder than errors detection. If auditor follows SA 240 procedures diligently with professional skepticism, and non-detection does not automatically means negligence. He has followed the procedure, he has done sampling, he has tested the controls well. Still he is unable to find, it's not auditor's fault. However, if the auditor ignored the red flags or failed to apply due diligence, failed to apply professional skepticism, then yes, he will be liable. Next is Miss XYZ and Co. are the auditors of POQ Limited. The CFO informs that the auditors that the company has strongly internal controls and there is no need to check the revenue entries separately. Again, we said there are two main risks. First one is what? Auditor has to maintain professional skepticism, apply due diligence, SA 240 requires, presumes that two type of risk, revenue risk and management override of controls. Write the entire thing. I'm just explaining ऊपर से here. Then next one is state two types of frauds as per SA 240 with one example each. That is fraudulent financial reporting, inflating revenues, and misappropriation of assets, cash misappropriation. You can give this example. Then there are MCQ traps also, which we can discuss. Primary responsibility for fraud prevention lies with the auditor. False, right? It's with management and TCWG. Next one is auditor provides absolute assurance against fraud. No, he provides reasonable assurance. Revenue recognition. Fraud risk is presumed only when the red flags exist. SA 240 treats revenue fraud as default presumed risk, right? It's not only when the fraud exists, red flags exist. Next one is management override need not be tested. False. It has to be tested, as we discussed. You can't say that okay, there are controls in place, everything is fine, CCTV cameras are there, there is make checker, I need not check. Still, there is a risk of collusion among people, right? There is risk of collusion among employees. So you need to test the samples end to end. Management override, this is tested, okay, this is done. Both error and fraud involve intentional misstatement. No, error is unintentional. You make mistakes, that is unintentional, but fraud is intentional planning. Intent is the only difference, right? Got it? And this is what SA 240 is about. Everything you need to understand in 60 seconds. What is that? Let's recap. Fraud is intentional, whereas the error is unintentional. Intent is the only difference. And there are two types of fraud. There is fraudulent financial reporting, that is cooking the books, and misappropriation of assets where the employee steals steals the cash, or creates a fictitious vendor and makes fake sales and transfers the money and he gets the money. That's it. Third one is fraud triangle, that is there is incentive. You see, there is a pressure from your family that you need money. There's opportunity. I can create a fake vendor. Opportunity is there, and I'm the one who is approving it. And rationalization. Rationalization is basically nothing but you find it okay. Like company is doing well, I'm getting underpaid, so let me do it. It's okay. That's the mindset. All three comes together, then it is a fraud triangle. Primary responsibility of is of management and TCWG and not the auditor. Next one is auditor gives only reasonable assurance. Auditor does not give absolute assurance. And then sixth one, always presume. What is the thing that's already always presume? Revenue recognition fraud and management override of controls. Management can bypass the controls. This is the thing. And the seventh one is if fraud found, then report it to management. Report, and if it's against the management, report it to the board, and then against the board, then report it to the regulators. That's it for today's video. And if you have any doubts, you can just comment below. Thanks for watching my video, and please do follow, like, and share. Thanks.